Welcome friends. In our course of international business, now we have started this very important concept of foreign exchange, the forex market. So, we discussed in the last lecture what is this foreign exchange. We have heard of stock exchanges, right. So, where stocks are exchanged, people buy and sell shares. So, similarly the foreign exchange market is an international financial market, which is a 24-hour market, and here the transaction between different currencies are happening right. So, when somebody wants to buy buy dollars, or it can buy Indian rupees, or it buys euro, or it buys sterling, whatever. So, yen. So, the major currencies. So, it can, for making any transaction between two different countries, you need a vehicle, you need a currency basically that is acceptable to the other partners. So, in order to do that, to make this business easy, foreign exchange comes handy. Okay. So, in the last lecture we discussed about who are the participants in this foreign exchange market. So, we talked about the central bank, the commercial banks, the corporations, the individuals, the fund managers, right, the fund agencies, and all these different, the brokers. So, there are 6 basically people who are involved, and how it is important that you need to be very careful in the foreign exchange market, because here it is played on a very huge volumes, right. In fact, if you remember, I had said that we almost spent about the amount of transaction that happens is more than 6 trillion US dollars per day, right. So, that is an enormous amount of money, right. So, any difference, that means the large players who play on arbitrage and who work on hedging of funds and all, they work on very small fractions, very small portions, but those amounts are very huge again because of the sheer size. So, today we will continue with this lecture, and we will first understand what are the functions of the foreign exchange market. So, the foreign exchange market basically has 3 functions, as you can see. One is called the transfer function, the other is called the credit function, and the third is called the hedging function. So, the first function, let us start, is very easy, and which says the transfer of purchasing power or clearing function. The basic function of the foreign exchange market is to facilitate the conversion of one currency into another, right. So, rupee to dollar, dollar to yen, yen to sterling, sterling to pound, whatever. The transfer function is performed through the use of credit instruments such as bank drafts, bill of foreign exchange, and telephone transfers, right. Examples are, for example, remittances or education fee made through transfers. Okay. If an American businessman plans a trip to India, he exchanges US dollars for Indian rupees, because if he wants to eat a dosa or a paratha in India, he cannot pay in US dollars, because nobody is going to take his US dollar. Many people might not, unless the hotel or restaurant is a very big one and they accept dollars, that is a separate thing, but otherwise it is not possible. So, to make its business trip sound, or its even to visit for any leisure trip, they need the Indian currency. So, all these exchanges is the first job that the foreign exchange market does. This is the first job. So, transfer function. The second important function of the forex is that the foreign exchange market provides credit to both national and international players to promote foreign trade. Okay. Suppose an Indian company wants to purchase machinery from US, right, some capital intensive machinery from the US. It can pay for the purchase by issuing a bill of exchange, right, in the foreign exchange market, essentially with a 3-month maturity. So, that credit, how would this credit be given? So, to give this credit, there is a 3-month maturity period which is given, right. On basis of this, the foreign exchange market provides a credit at some, maybe some benefit, some small benefit, right. So, this credit facility, the provision of credit facility helps the buyers to buy instruments or technology or anything for which they do not have money immediately, or even sometimes it is not wise to pay the money, because they would try to take some time, unnecessarily they can get a 3-month period. So, that trade off has to be seen now, which is how much beneficial, and the company can take its stance. But whatever, the provision of credit is an important function of the forex market, right. The third is the provision of hedging facilities. Now, I explained in the last lecture that hedging means, we mean covering of a foreign exchange risk, right, arising out of the changes in exchange rates. Now, suppose you have purchased something and because after purchasing suddenly the price, the value of the currency but that has been used, the dollar has changed. Now, because of this change you might make a loss, right, you have to pay more now, right. So, in this case the when you have to pay more dollars, that is a loss. So, such a loss in a small business is still okay, but when you are talking about millions and millions of transactions and of millions and millions of rupees or money, in that condition even a small fraction, even 1% change can make a tremendous impact, right. So, when exporters and importers to enter into an agreement to sell and buy goods on some future date at the current price and exchange rate, it is called hedging. So, what happens here? The exporter and importer have entered into an agreement to sell and buy the goods on some future date at the current price and exchange rate. So, the rate would be maintained. The purpose of hedging is to avoid losses that might be caused due to the exchange rate variations in the future. Let us see. An Indian exporter has made export worth $1000, right. So, he has made an export worth $1000. In this time period suddenly what has happened, the current spot exchange rate is $1 is 60 rupees. Okay. So, how much he would get? He has made an export of, let us say, handicrafts. So, he will get 60,000 rupees, 60 into 1000 at the set date, suppose after 3 months. Okay. Now, if the rupee appreciates in between to 50, now $1 has become rupees 50. So, that means the rupee has become stronger, right. So, after maturity he will only get now how much? Now, 50 into 1000, so 50,000. So, that means there is a loss of 10,000 due to the appreciation, right. So, that is why it is said many a times when the value of when the currency appreciates, it is bad for exports, right, and it is good for imports, right. So, now he can hedge his position by signing a contract with a financial institution after payment of the hedge premium. So, he pays a hedge premium, there is a premium which they calculate, right, and makes a contract like in the case of a life insurance premium. So, as in a life insurance premium you say ki I will pay monthly 250 rupees for let us say 10 years, and if even in something happens to me in between, so my family gets this much of money, right. The exporter can take an option to sell $1000 at rupees 60 for the particular future day, say 3 months. He can save his potential loss by performing this contract, but this is one side of the story, right. But the other side could have been that the money has depreciated, right, and instead of 50 it would have become 70, let us say. Now, what would have happened had it become 70? So, $1 is 70. So, now the exporter would have got, let us say, had it depreciated, he would have got $1000 into 70 rupees. So, that means in a secondary case where it has not appreciated but depreciated, the person would have got maybe 70,000 rupees, right. So, that is a benefit to the exporter, right. But in the international market, the foreign exchange market is such a huge market. So, controlling such markets is nearly impossible, right. So, it is better to play safe. So, how do you play safe? By having a contract that whatever is the price today 60 rupees, whether it may appreciate tomorrow or it may depreciate tomorrow, I am not interested, I want to get only 60 rupees worth of my product, right. So, at least his rupees 60 is safe. In case had it depreciated he would have got 70,000, had it appreciated he would have got 50,000. Now, he is getting neither a loss nor a profit, at least the worth of his product. Okay. Now, what factors are affecting the exchange rate, right? So, foreign exchange rate is one of the most important means through which a country's relative level of economic health is determined, right. Obviously, because all the transactions and businesses are done through this foreign exchange, right. A country's foreign exchange rate provides a window to its economic stability, which is why it is constantly watched and analyzed. So, there are people who are constantly watching and analyzing it, because a small change can have a big effect, right. For example, imagine a country like China, which is highly export oriented. Now, if the Chinese currency yuan appreciates, what will happen to the exporters? So, entirely if China is, let us say, exporting $100 billion worth of goods, and the yuan appreciates by, let us say, 10%. So, that means on 100 billion, it on 10% is simply 10 billion. So, there would be a loss of 10 billion, this is only a mathematical calculation, 10 billion, just because there has been a currency change, right. So, it may, so you can understand how important this thing is. It may fluctuate daily with the changing market forces of supply and demand of currencies from one country to another. So, that you cannot have a control, the entire world is connected, right. So, I am buying from oil from Iran, I am selling, now I am making some products out of it, and I am selling those products to, let us say, Cambodia, I am selling these products to Australia. Now, Australia is using these products, the Australian companies, and they are making something. So, the whole world is like chained, they are all tied up, right. So, it is like something like one change somewhere will have an influence in some other place also, right. So, it has to be very, one has to be very careful in understanding this supply and demand principle in the foreign exchange market, right. So, for example, how much demand of the dollar is there today, right. Is the dollar's demand is increasing, or is it remaining same, or is it decreasing? Suppose, let us say, the dollar's value or importance will decrease with time. That means what? Less countries will trade with the dollar, with the the US dollar, right. So, if they trade less with the US dollar, the need for US dollar will be less. So, if the need for the US dollar will be less, the importance of the US dollar goes down, automatically the US position of power will also get affected, right. Factors, some of the factors that affect the exchange rate are, for example, relative interest rates, the inflation rate, the income level of a country or the people, right, the intervention of the government, as sometimes the RBI intervenes to control the money market, right, the political stability and performance. Now, the exchange rate for a place which is highly volatile and highly is always into war and civil rights and all, and in comparison to another country which is highly a peaceful country, would be different. Country's current account deficits, government debt and speculation. So, you can see, so these are the different the variables or the factors that affect the exchange rates. Okay. So, let us see, let us go one by one. So, the first is the relative interest rate. Now, what it is saying? Australia's interest rate increases relative to other countries. So, the interest rate that Australia has is increasing, right. Investors will get a better return on Australian assets. So, the Australian dollar increases in value to the rise in demand. Now, if you understand, now because the interest rate has increased, so the Australian bank, let us say, is paying more. So, the people would like to invest more in Australia, because by investing they are getting more interest rates, right. So, what it says, higher interest rates offer lenders in an economy a higher return relative to other countries. Therefore, higher interest rates attract foreign capital and cause the exchange rate to rise. Now, this has happened also with India very recently, right. So, the Indian government recently, what has happened, some of the foreign players, they took away their money, right, and they fled off. So, this has resulted in a not only the change in the exchange rate, but also it affected the stock market, the stock exchange very badly, right. So, this has happened because of not only one reason, but many, one of them being the political reasons also, right. The impact of higher interest rates is mitigated or lowered, however, if inflation in the country is much higher than in others, right. Now, what it says, suppose X, the government is paying, the banks are paying higher interest rates. Now, So, to pay, if they are paying higher interest rates, so people, if I put in my money, let us say I will get higher interest rate. So, more money I will earn at the end of the year. But the point is, this will be nullified, alright. This will be lowered if the inflation in the country is much higher than others. If the inflation is higher, that means the cost of purchasing my basic commodities or goods is also higher. So, the amount of money that I am generating, I am losing out on the other side by paying more money, right, in buying the goods, right. So, if additional factors serve to drive the currency down, that is what it is saying. The opposite relationship exists for decreasing interest rates, that is, lower interest rates tend to decrease exchange rates, right. So, what happens when there is a lower interest rate? So, people are not interested to put in money in your country, right. So, the exchange rate or the value of your rupee will go down, right. Similarly, the second important thing is the inflation rate. So, all these are connected, but then still we are trying to see it in a discrete fashion. Okay. A higher rate of inflation will make a country's currency less attractive. So, if the inflation is high, that means, as I said, buying is costly. So, the currency will become less attractive, right, because its value has come down. With more money you are able to buy less goods, right, because of the loss of the real value with the inflation. So, if with 100 rupees I was able to buy, let us say 2 kg of potatoes, right. Now, with let us say, let us take the case of onions. If 100 rupees I was earlier buying 2 kg, 3 kg of onions, today I am able to buy only 1 kg of onions. So, that means because this has led to an inflation in the inflationary price. Now, this is, and if it happens to more number of products, then the cost of the things goes up, right. Countries with consistently high inflation rates tend to have lower currency values, right. This is because purchasing value decreases relative to the other countries and vice versa. You see this example, Venezuela's hyperinflation rate increased from 902 to 10,000,000% since 2018 according to the International Monetary Fund. So, you know that Venezuela's currency completely was destroyed, right, the economy was shattered, right. So, it went into a hyperinflation rate stage where you had to have loads of money. Even it happened in Zimbabwe, where they had to print currencies of 1 million worth each, right, notes of 1 million. So, in such higher inflation or hyperinflation states also, it has a very negative effect on the exchange rate. Okay. You see this example, this means that the price for goods in the UK increase quicker than European goods. So, UK goods will be less competitive, demand for UK exports will fall, and so there will be less demand for the sterling. This is the example we are trying to talk about, inflation rate, right. So, euro and UK, right. So, you can now connect maybe with the condition that if in the Brexit, Britain is now trying to come out of the that group. So, will it have a good effect or a bad effect? This is for you to think, right, and come out with some of some logical conclusion. The third point is the relative income level. Now, citizens with higher incomes, right, look for new consumption opportunities, where as the income increases, people think of new consumption opportunities in other countries, driving up the demand for those currencies and shifting the demand curve to the right. Now, for example, the income of people in India increases, right. So, as the income increases, so what they will do, they will try to look for newer opportunities. Let us say the newer opportunities what they are looking for are some luxury items or products which are not available in India, but they are only available in some other countries like Italy or France. Now, to buy those goods, to buy those products, maybe it is perfume or car or leather bags or something, they have to use the franc or sterling or whatever currency of the country is. So, the demand for that currency now goes up, right. So, thus as income rises in one country, the prices of foreign currencies rise as well, and the local currency will depreciate, right. So, now if the local currency will depreciate, you see this is like a tug of war, right. So, if the local currency will depreciate, what will happen? Now, exports will gain, right, but imports will lose. On import you will lose because you will have to pay more, right. So, as the local currency will depreciate, right. So, when the local currency depreciates, exports will gain because people can buy at a lesser price more products, but imports, while doing imports you have to pay more dollars, right. The government interventions, the fourth point, buying and selling of foreign currency in the market by the central bank as the Reserve Bank, for example, in India, with a view to increasing the supply or demand, thereby affecting the the exchange rate, right, is known as intervention. So, there has been a lot of debate on this ki how much should the central bank intervene. In fact, the central bank's role is to intervene, but by intervening they affect the exchange rate. So, to what degree should they intervene, how much intervention is correct at what point of time is always a debatable issue, right. So, the governments may influence the equilibrium exchange rate by imposing foreign exchange barriers, imposing foreign trade barriers, intervening in the foreign exchange market and affecting macro variables such as inflation, interest rates and income levels. Let us look at this example. China wants to keep its currency undervalued to make Chinese exports more competitive, right. Because as I said earlier also, China is largely an export driven economy, right. So, it would like to keep its currency undervalued, so that people can buy more of Chinese products. China sells its yuan and buys up US dollars, right. With less supply of US dollars, the value of the yuan decreases. With less supply of US dollars, the value of the yuan decreases. Compared to the now higher dollar, the yuan is relatively cheaper. So, as you see, value of yuan related to the USD and quantity. So, as it says, when this happens, the government intervenes sometimes. In fact, in China and Japan, the currency was devalued so that it would help their exports, right. So, that also has a very large impact on the exchange rate. You look at this example. In 2007, India experienced rapid appreciation of its currency against the US dollar in 2007. The reason for the appreciation were a generally weak dollar in the international currency market. So, the dollar had become weak and sharp increase in dollar inflows into the country, partly due to India's increasing attractiveness to the foreign investors, right. So, the foreign investors found India to be an attractive market. They wanted to set up their own plants, they wanted to have assets in India, they wanted to put money in the stock market. Although India had been seeing a steady rise in dollar inflows into the country for quite some time, the RBI intervened in the foreign currency market and purchased the excess dollars so as to avoid any appreciation in the value of the rupee. Because if the RBI had not intervened, that means what would have happened, the rupee would have appreciated, and had the rupee appreciated, what would have happened? The exports would have got affected, there would have been an adverse effect on the exports of Indian exports, right. So, major Indian businesses which are lying depending on exports, they would have seriously got affected, right. On November 24, 2016, the rupee hit a record low of 69.09. Now, it is 71, right, sliding past its earlier trough of 68.86. So, to curb the Indian currency's fall, now the currency was falling, the RBI sold 400 to 500 million in the spot market, right, in some time, right. So, what happened? What does the RBI do? The RBI is holding this dollars, right, the currency, and at some time it would like to buy, right, or in some time other time it would like to sell off. So, here in this case, when it was at a record low, and it was going up again, it was going 69, 70 towards. So, to curb the Indian currency's fall, so the Indian currency would not be looking weak, the RBI sold off the sold 400 $500 million. So, by selling of the dollars it wanted to stop that fall of the Indian currency. So, these points are very interesting and they need to be very carefully understood. So, if once you understand them, then it will be very clear to you how international transactions are happening and how each one is getting affected by the other, right. September 2018, India raised the import duty on a range of items including air conditioners, refrigerators, washing machines, footwear, jewellery, furniture fittings and tableware, besides imposing it on aviation turbine fuel ATF, as the government seeks to rein in the current account deficit and shore up the rupee. So, the Indian government, right, raised the import duty. So, it by raising the import duty, so what it did was it made the domestic players more competitive and the outside players or the external players less competitive, right. Although it is not advised and it is always criticized by the WTO, but still sometimes looking at the local condition and the income level and the people's condition, the government does it, right. So, the government tried to help the rupee, right. The next point is the political stability and performance. Now, a country's political state and economic performance can affect its currency strength, right. So, as I said, if there is a lot of violence, unrest, civil rights and all, it affects the performance of the foreign the currency. The foreign investors inevitably seek out stable countries with strong economic performance in which to invest their capital, because everybody is scared. If a war goes on inside the country, then how would we get back our money, right. In fact, in some of our classes I have explained, or maybe in the future I will explain how these things get affected when there is a violence or a disturbance in a country. A country with such positive attributes will draw investment funds away from other countries perceived to have more political and economic risk. No wonder for some of the African nations, some of the other nations which have always been into some kind of a war, turmoil, they have been not able to attract investments, right. If an economy is growing at a faster rate in the long run, it is generally expected to have a better performance on the balance of trade, right. Political turmoil, for example, can cause a loss of confidence in a currency and a movement of capital to the currencies of more stable countries. So, if tomorrow India has a lot of disturbance, be it for any reason, internal reason, I just don't want to name anything, but for any reason there is a instability in our country, then the foreign investors would not be very much interested, and I am not surprised today that the stock market there is a disequilibrium and the markets are not doing that great. Although at one point the Nifty is growing, the Sensex is growing, but other side many shares are not doing well. So, many stocks are not doing well. So, the point is such kind of loss of confidence can be a bad thing for any country. So, political stability is very important. If markets feared the US would default on its debt, foreign investors would sell their holdings of the US bonds. This would cause a fall in the value of the dollar. So, this is one of the greatest fights that is happening, right, which the common man is not much aware of, that because US has a lot of debt, right, is one of the highest is the countries with the highest debt, but and it knows very well that if the people will be losing confidence or they will be scared, then they would run away and they would not put in their money. But and if the US dollar does not stay strong, in fact, then US power or hegemony or the point of the position of power, they would lose it, right, the supremacy. So, there is a constant fight with the oil countries, oil exporting countries and all of US, and US is trying to have the shale oil and other things, so that it can control this dollars value, right. So, this fight of dollar is not linked only to the financial market, but it goes out to the to the real war also, right, sometimes. Let us take this example. Vietnam, for example, is controlled entirely by the ruling party. The economy is one of the most volatile in Asia. What once was thought of being a promising economy has recently been in distress. Vietnam's macroeconomy was relatively stable in this period 97 to 2006 with low inflation, a 7 to 9% output expansion annually and a moderate level of trade deficit. But Vietnam could not bother the adverse impact from the 1997-98 Asian financial turmoil which happened in the 97-98 time, which partly curbed the FDI flow its economy into its and affected the exchange rate. Starting in late 2006, both public and private sector firms began to experience structural problems, rising inefficiency and waste of resources because of political instability. So, political instability has a tendency to outweigh any positive outcomes from current government and related currencies will usually suffer loss. What it means is simply the government may intervene to do lot of things, you might do lot of good things, but the point is if there is an instability in a country, for example, there is no clear government and there is a lot of disturbance, then the outside players would not show interest because they will be always afraid of because of the stability or instability, the country the value of their currency will fall, right. So, today what we have learnt is we have tried to understand what are the different factors that affect the foreign exchange, and some of them being for example, the political stability, instability, and the inflation, the interest rates, the government's intervention, etc. So, we will continue with this factors affecting the foreign exchange market in the next lecture. So, thank you very much for the day. Have a nice day.